Nifty has been stuck in a 400 point range for the last 5 months. Let's see what the inflection point leads to. We have the earnings tail this week, the FOMC minutes, and the 24,500 magnet, which is acting as a make or break level. So as we can see, USD INR is sustaining at 95 and Brent crude is also testing 82, which are both positive. FI sold a little bit of uh, in cash market, but the DII is bought aggressively, so the market is being held up. The RBI has revised their GDP forecast to 6.7%, and also the CPI forecast has been revised up to 5%, which is concerning for bond yields and slightly hawkish. The focus should be to focus on quality over quantity. You have to focus on whether your stock held the gains 3 days post the results. That shows that they're institutional buying. In September, we have another FOMC meeting, which the market is giving a 60% chance the Fed hikes rates. That could make the rupee test 96. However, the 24,500 level is acting as a magnet, and plenty of put selling support is over there. And the DIIs are absorbing all the selling by the FIIs. So if the crude stays below 95 and 85, it should be positive for the Indian markets. Moving forward, we are seeing edge in private banks and capital goods over all the other sectors in India. And the sectors we would avoid would be FMCG because of El Nino effect. There might be weak rural demand. And in metals, there's China demand worry and steel prices are rolling over. So both of these scenarios are bearish. So we would be long private banks and capex. What breaks our long thesis? If crude goes above 90, or if the FOMC is really hawkish, or if the monsoon deficit is more than 15%, or Nifty breaks 24,000. If any one of those happens, you should cut your equity exposure by at least half. So finally, what's the trade plan for this coming week? In core, we are long Nifty, we are long Bank Nifty as well, and we are long small capex names like L&T. In hedge, we don't have a USD INR hedge as our policy does not state that we need to hedge that. And in cash, we are holding about 20 to 30% cash, which we are looking to deploy on dips. So the one thing to remember is whenever there's a tight compression, it is always going to resolve violently. So it's either going to break 24,500 and explode to 25,000 or break 24,000 and go to like 23,500. So be positioned for it and trade the range and size small. That's all for today. I hope you guys enjoyed this session and stay tuned for more.